Hi, I'm Srishti Bhattrai Pandey. My student ID is EMB23019. I'm here to discuss about the individual assignment of corporate accounting. The assessment title is Accounting for Income Tax. My unit code is HI5020. The report has been prepared for the assignment for the corporate accounting. I have reviewed the annual report of the ASX annual report of the company and reviewed the income statement, balance sheet and cash flow of the Woolworths Group Limited. Woolworths is the largest supermarket chain at Australia, operating 995 stores, 115,000 team members in stores, distribution centers and support office. It is the most renowned for all customers due to the customer service and having of fresh and hygienic products like vegetables, meats and many more things. Hence my report is based on the income statement, balance sheet and cash flow statement only. The company is so fascinated with the customer service about the complaints, refund and the product and service. The company provides the product sometime in a lower price by giving the name sale. The concept of the annual report of my assignment is based on accounting profit, taxable profit, temporary difference, taxable temporary difference, deductible temporary difference, deferred tax assets, deferred tax liability. Accounting profit for the company is the total earnings which is calculated in accordance with the accounting standards of the country. Basic understanding of the accounting profit is total revenue minus expenses. Taxable profit, it is the number that is used to calculate tax on income. It tells us how the company owes to the government. Temporary difference. A temporary difference is the difference between the carrying amount of an asset or the liability in the balance sheet and its tax base. Taxable temporary difference. A taxable temporary difference is a temporary difference that will yield taxable amounts in the future when determining taxable profit or loss. Deductible temporary difference. A deductible temporary difference is a temporary difference that will yield amounts that can be deducted in the future when determining taxable profit or loss. Deferred tax assets. Items on a company's balance sheet that may be used to reduce taxable income in the future are called deferred tax assets. Deferred tax liability. Deferred tax liability is a tax that is assessed or is due for the current period but has not yet been paid. The deferral comes from the difference in timing between when the tax is accrued and when the tax is paid. Now I am going to discuss about deferred tax assets and liabilities. Both deferred tax liabilities and assets should be recognized gross in the balance sheet unless the entity has legal rights to set off the two or they pretend to the same taxation authority. Deferred tax assets and liabilities are offsets. If there is a legally enforceable right to offset current tax liabilities and assets, and when the deferred tax balances relate to income taxes levied by the same tax authority. Now I will discuss about the firm's tax expenses in its latest financial statements. According to the consolidated statement of comprehensive income, the income tax expense is 668 million and 718 million in the year 2019 and 2018 respectively, as shown in the figure. Now I will discuss about company tax rate in the accounting income. The main principles of accounting for income tax are that a company should recognize both the current tax consequences of the transactions and events of the period as reflected in the calculation of taxable profit, the future or deferred tax consequences that will arise from the recovery of assets and settlement of liabilities. Now I will discuss about deferred tax liabilities in the balance sheet. In the Woolworths balance sheet, deferred tax assets is 311 million and 217 million in the year 2019 and 2018 respectively, as shown in the figure. Now the current tax pay recorded by the company is current tax payable in the balance sheet of the company, which is 84 million and 110 million at the year 2019 and 2018 respectively. The income tax payable not the same as income tax expenses, because income tax expenses are the thing that we calculated that our organization owes in the tax dependent on standard business accounting rules. Now I am going to discuss about income statement and cash flow statement, tax expenses and the difference. In the annual report of Woolworth Group Limited, there is a difference in tax expenses and income tax paid in the income statement and cash flow statement respectively. In the cash flow statement, the income tax paid is 744 million 661 million at the year 2019 and 2018 respectively as shown in the figure. Now, permanent differences. The permanent difference of the Woolworth Group Limited in the financial statements are fines and penalties, paid interest and meals to the employees. The firm's tax expenses. The most interesting fact about the tax treatment in the budget or financial statements is that the organization report tax expenses disregarding having a misfortune before charge. Actually, the annual income tax expenses misfortune is accounting for the financial year, which is extremely fascinating to note. Now, conclusion of my annual report. Woolworth is one of the companies in Australia to generate the higher revenue. The company is so fascinating with the customer service about the complaints, refund and product and service. The company provides the product sometimes in a very lower price by giving the name sale. After going through the ASX annual report that is mentioned parts of the corporate accounting, it can be summarized that income statement, balance sheet and cash flow of Woolworth Group Limited has been analyzed and discussed as per the requirement. Thank you.